We're picking up what you're
Goodwill,
putting down.
goodwill. Yeah, so this is going to be a little bit of an accounting discussion here. We're going to be looking at a
I'm
line
gonna
item on
tune
the
out for a
balance
while.
sheet and the
So
financial statements. And that is going to be, as Ryan said, the line item of goodwill. No, goodwill, goodwill. Okay.
I want some
So,
Goodwill.
most of the people that watch the podcast probably aren't going to necessarily do a lot of in-depth financial analysis on a company when they're looking at a stock. That's what they would use us for. But goodwill is a topic that has come up, and I'm sure that most investors have heard of it, whether or not they know what it is or what the implications are. So it's good to just kind of walk through and give a general idea of how one would treat or how we look at goodwill. So this comes from a viewer question. The question was just wondering if one of the Keystone presenters has discussed how to treat goodwill when doing a company analysis. For example, if you subtract balance sheet goodwill as an asset, the book value of a share is decreased proportionally. Is goodwill a red flag when doing ranking of companies? Excellent question, and I am happy to answer this. So, first of all, let's explain what is goodwill. Well, goodwill is an accounting item on a company's balance sheet. So this accounting item arises when a company makes an acquisition. And what goodwill reflects is the amount paid for that acquisition over and above the fair market value of the assets being acquired. Let's look at an example. So say you are a company and you're acquiring another business. You're acquiring this business for $120 million. And during the negotiations, of course, you sent your accountants over to the company to look at all the assets, do an evaluation, and they valued the assets. They provided a fair value of the assets of $100 million. So you're paying 120, the fair value of the assets is 100. The additional $20 million of residual value in this acquisition would be listed as goodwill. So why is that? Why would you, as an acquirer, pay more than the fair value of the assets that you're acquiring? What does this goodwill represent? So what it means is that you believe as the acquirer that the business that you're acquiring is worth more than the fair value of the assets. That is the assessment that you're making. And there are a number of reasons why the business may be worth more than the fair value of the assets. So it could be a very strong company with strong branding, or very strong customer and supplier relationships, or maybe because of the network of talent that the company has, or the operating processes that it's developed over the years, or other forms of intellectual property or competitive advantage. But the bottom line is that there's something in that business that you believe is worth paying for that is not necessarily reflected in the fair value of the listed assets. So now the question that was asked is goodwill a red flag when evaluating or ranking companies? And the answer is not necessarily. So there are a lot of factors to include here, and it really depends on the individual company, the individual track record, the industry that the company operates in. How much goodwill are we talking about? Are we talking about a little bit of goodwill or a lot of goodwill? And then just the overall balance sheet, what the balance sheet looks like in terms of debt, other assets, and then financial performance. So these are all things that need to be factored in when looking at goodwill. Now, there are risks in having too much goodwill on a company's balance sheet as an investor investing in that company. So, goodwill can certainly be a sign that the company that you're investing in has overpaid for acquisitions. Not necessarily, but it could be the case. Another thing to consider is that goodwill the company has to review it annually. And if they believe that the goodwill has depreciated in value or is less than what they originally thought, then there will be a non-cash write-down or a non-cash expense to reflect this. And another thing to consider is that goodwill is not a real asset with a tangible value. So it's not something that can be resold or would necessarily have value in an acquisition. It's simply an assessment that the company makes. So our take on goodwill, and is goodwill a red flag when we're looking at a company, and how much does it actually factor into the investment decision for us? Well, the truth is that one thing that's important for a stock investor to understand when they're thinking about the balance sheet is that the asset values on the balance sheet don't actually reflect what one would consider to be the true market value of those assets. That's not the way that it works. Generally, when you're looking at an asset recorded on a balance sheet, that's essentially the cost that was paid for that asset minus any depreciation over the years. And depreciation is in and itself just an accounting estimate as well, and may not actually really represent the real depreciating value of that asset. So anytime you're looking at asset values listed on a balance sheet, you can't look at those from the perspective of this is what these assets are worth. Or when you're looking at the equity on the balance sheet, that this is what you would get if the company were to sell all of its assets and pay off all of its debt. These are not values that we can really depend on. And for that reason, we don't really look at asset values when we're evaluating a company from a valuation perspective. Now, what we do use the balance sheet for is we use the balance sheet to assess financial health and debt leverage. And goodwill can factor into that. But it's one of many, many things that we look for. And as I discussed before, there are a lot of other factors to consider, like the industry of the company and just the overall condition of the financial performance and the balance sheet. So really, we do not use the balance sheet when it comes to doing valuation on a company. When we're doing a valuation on a company, we're looking at revenue, we're looking at cash flow, we're looking at earnings. And typically it's the revenue and the cash flow versus the debt that we will use to evaluate the financial health of a company as well, as opposed to the recorded values of the assets. So just on some final thoughts here, some additional thoughts here. Some goodwill is certainly going to be inevitable for companies that make acquisitions. So if you are investing in a company that does a lot of acquisitions, maybe that's a part of their growth strategy, they're likely to have goodwill on their balance sheet. Now, a cleaner balance sheet is always better. Certainly, we would prefer likely to see no goodwill or no assets where we can't determine a tangible value for that asset, but that's not realistic. Excessive goodwill is certainly something to look into, but goodwill itself is not necessarily something that would dissuade us from investing in a company or would cause us to rank it at all differently relative to other companies as well. Typically, when we're looking at acquisitions and how well a company acquires other businesses, we're going to be looking at the track record of that company. And the earnings and cash flow accretion, or per share earnings and per share cash flow growth that they've been able to generate through their acquisition strategy. Of course, this is all relative to how much debt they use for acquisitions, how much equity. But we're really looking more at the track record as opposed to a couple of balance sheet items. Most good companies, however, are going to be worth more than just the fair value of their assets. So just looking at the goodwill or taking the position that goodwill is bad is not something that I would agree with. In fact, I've heard the saying in the past, I don't know who said it, but the saying is goodwill is just the amount that a company is overpaid for an acquisition. And while I can understand this mentality, I don't think that it's really really accurate. Because most great companies are going to trade at, are going to be worth more than just the fair value of their assets. And I'm just going to use the example of Alphabet. So this is the company, one of the largest companies, top technology firms in the world, owns some of the most incredible technology platforms in the world, like Google, like YouTube, like Google Cloud. So Alphabet, their total value of their assets minus the cash on their balance sheet is about $230 billion. Yet the company produced nearly $100 billion in cash flow just over the last year. So if somebody were to purchase Alphabet, if Alphabet were to be acquired by another company or another person, clearly the value of the company would be more than just the fair market value of their assets. Clearly there are brands, processes, technologies, talent, connections in place in the business that make the total value of that company more than just the value of its listed assets. So goodwill is not necessarily a value that doesn't exist. It's not necessarily a company's overpaying for assets. Could mean that they're overpaying for assets, but it really just it's really just an accounting term that reflects the difference between fair value and what a company's actually worth. And we can go through many other examples as well, McDonald's or other great branded businesses where, certainly if you were to buy the company, you would have to understand that the purchase price you would pay would be more than just the company's real estate buildings, office supplies, and equipment. There's branding, there's other competitive advantages as well. And that's essentially what Goodwill reflects. So that's our take on Goodwill. One of the many things that you may want to consider if the value is very large, but ultimately it's not one of the most important things we would look at when we're valuing and ranking companies. And in fact, it's probably one of the lower things on the list that we would look at in terms of importance.